As I mentioned a moment ago, the NYSE's parent company, Intercontinental Exchange, released its August mortgage monitor out this morning, giving home buyers and sellers new data on housing market trends. Andy Walden, ICE's head of mortgage and housing market research, joins me now from Denver with more. Andy, always good to see you. We appreciate you getting up early. And let's dive right in here because according to the latest report, mortgage lending hit its highest quarterly volume in 3 years. What is the level and what was behind it?
Yeah, I mean, the origination volume for the second quarter is roughly $500 billion lent out there. A few reasons behind it. Again, this was a relatively modest uptick, but a little bit of an improved interest rate dynamic at the beginning of that quarter. You have more homes available for sale than we've had over the last few years out there in the market, providing more home sale and lending opportunity. And we also saw a little bit of a boost in cash out lending, borrowers withdrawing equity from their home through refinances. That hit its highest level in nearly 3 years. All of those combined pushed origination up a little bit in the second quarter of this year.
I do want to drill into that cash out activity, as you mentioned, continue to drive the majority of refinancing lending, according to the report. So for those who might not follow the housing market on a day-to-day basis, take us through this strategy and how it compares to rate and term refinancing.
Yeah, so rate and term are the traditionals that you think of, right? When you think of borrowers refinancing out there in the market, reducing their interest rate, extending their term, reducing their monthly payment is again traditionally what we think of in the refinance market. Cash out lending a little bit different. It's borrowers withdrawing equity from their home through refinances. That drove about 3 in 5 refinances in the second quarter of this year. And it's borrowers that in today's market are primarily raising their interest rate to do that. The average cash out refinancer raised their interest rate by almost 1.5 percentage points in the second quarter of this year, while they withdrew about $94,000 in equity from their home on average.
Your report shows that services are struggling to identify and retain those refinancing borrowers, especially those refinancing to withdraw equity. What can lenders and servicers do to better identify and retain those customers?
Yeah, it's a great question, right? And when we look at lenders and servicers alike, typically what they're good at is retaining borrowers that they've worked with recently. So in today's day and age, it's borrowers that took out their mortgages in 2023, 2024, knowing that they were going to refinance, or just simply identifying borrowers that have that interest rate incentive to refinance in today's market. That's where the bread and butter from retention is. When you get outside of that, and even within that bucket, they're still losing about half of those borrowers. But you get outside of that into those cash out refinances, and they really struggle to identify those borrowers. There's a couple of ways that they can improve that. One is through simple technology solutions, right? ICE just released an enhancement to our MSP platform that allows borrowers to self-identify their equity that they have available in their home, what interest rate offerings are available to them out there in the market, fill out a mortgage application directly from the servicing system that can then route them through the origination channels that can benefit folks from a retention standpoint. For folks where that's not available, deeper market-driven analytics to really understand who's transacting in the market, why are they transacting in the market, to improve your marketing efforts and put the right products in the right place at the right time to the right borrowers can help improve those retention metrics as well.
We saw home price growth in the U.S. slow to 1% in July versus 1.3% in June and 3.6% toward the start of the year. How is that impacting equity?
Yeah, and I mean, if we focus on just the home price growth rate for a moment there, that 1% home price growth in July, outside of April and May 2023, right after the Fed started raising interest rates, that's the softest price dynamic we've seen in the market since 2012. And so you've seen a very noticeable cool down in the housing market out there. When you look at how that impacts equity, we still saw home equity hit a record level in the second quarter of this year. It was a little bit earlier in the quarter. As we made our way through the tail end of Q2, you started to see equity begin to pull off of its peaks at the national level. And then when you look at some of these markets that have been heavier hit by this home price softening, Austin's a great example of this. Austin home prices are down about 20% from where they've been in recent years. You've seen some very noticeable equity erosion. In fact, the number of borrowers that are underwater that have purchased in recent years has been rising, and the amount of equity available to borrow against in Austin is down 38%. So nationally, we're still in a pretty good position from an equity standpoint, but you are seeing some of these pockets of Texas and Florida, where home prices have come down 10, 15, 20%, you're seeing some pretty noticeable equity erosion and some equity risk starting to emerge in some of those markets as well.
Investors are pricing in an interest rate cut from the Fed in September. What might that mean for mortgage rates?
Yeah, it's a great question, right? So if you look at loans flowing through our technology solutions last week, as you can see on screen here, average interest rate offering about 6.65%. If we dip into some of the futures market data there to kind of understand what the market is pricing in, they're saying, mortgage rates in the 6.3, 6.4% range by the tail end of this year is currently what's being implied by those futures pricing. So 0.25%, maybe a little bit over 0.25% interest rate improvement as we make our way through the tail end of this year is the baseline expectation. Could provide a little bit of improvement for home affordability out there in the market. It could provide a little bit of interest rate incentive to refinance, especially for folks that have taken out their mortgage rates in the low 7% range as we get into the tail end of this year as well.
Andy Weldon, ICE's head of mortgage and housing market research, joining us this morning from Denver. Andy, thank you.
All right, thanks, Kristen.